The impacts of COVID drove our market up 100%. And now we're dealing with a situation where vacancies have spiked. Corporate America woke up, figured out they had too much space. All the 3PLs figured out they had too much space. They'd taken space unnecessarily, again, with kind of wrong judgment or misguided, facts in making their decision. And again, it was hard to make decisions during COVID because obviously the times were uncertain and unprecedented. So what's happened in summary since the beginning of 23 is we've seen vacancy rates go from that 5.5% all the way to 6.8% just literally in about a 15 to 18 month period.
My gosh.
Those vacancy rates are continuing to go up. I'll touch a little bit on the subtleties of that, but when vacancy rates go up that dramatically, we've seen prices change in return.
Welcome to our Industrial Advisors podcast. You have Bill Condon and Matt McGregor, and we have a great guest today, Steve Bellitti. Steve's been on before. He is year in and year out a top producer at Colliers, the entire company, and always one of the top industrial brokers as well. He is based in the Inland Empire. I always call him the king of the Inland Empire, which is obviously a big part of the overall industrial real estate in the U.S. So it's great to have Steve on. Steve's also a friend of ours, and wonderful to have you on again, Steve. I think this is probably your third or fourth time. You're so good at it that we're having you on.
No, thanks for having me. I'm glad to be here, and it's really good to see you guys. And hopefully I'll get a chance to see you in person here in a couple of weeks.
Absolutely.
For sure. So today what we wanted to just cover was overview of the Inland Empire and what's going on in that market trends, and then we're going to touch on the impact of the wildfires that unfortunately took place and what kind of impact that's had on the industrial real estate market there.
The Inland Empire is really the growth market of Southern California. Southern California is the largest industrial market in the United States. It makes up 1.8 billion square feet industrial base here in Southern California. The Inland Empire is the most furtherly east portion of that base. It's about 650 million square feet. And again, really the growth market, year in and year out, the Inland Empire is the most dynamic industrial real estate market in the country. It's really the bellwether for, everything that happens here in U.S. The key drivers of the Inland Empire are, first off, the population base here. We have about 25 million people here in Southern California that drive the market. And then the other key thing is the ports. If you look at the annual volumes of the ports, that all the imports that come into the U.S., annually, about 42% of all the goods that come in the U.S. come into one of those two ports, either the Port of Long Beach or Los Angeles. So a huge driver for imports, obviously very topical today with what's going on with our administration. But again, a key bellwether for the industrial real estate market here in the U.S.
Maybe touch on that, on the administration, the tariffs. Are you seeing companies start to stock up on backstock or anything like that to avoid tariffs?
Yeah, I think there's a little bit of that. We have an appliance company that we do work with that makes a lot of the appliances down in Mexico, and they're pushing product up, and they've actually leased some auxiliary space just to kind of get ahead of the tariffs, knowing that they could potentially be coming. But the problem is, most of our imports aren't products that you could just store forever.
Sure.
And then also storing them is very expensive. Obviously you can't store scarves, you can't store really any apparel because it's also seasonal and it's also trendy that in 6 months it'll be outdated. So you can't really beat the tariffs, but it definitely is creating an uncertainty around our market, and certainly has impacted, corporate America's decisiveness in moving forward with expansion or decision-making here in Southern California.
And tell us the current condition versus peak of market. I think you got down to 1% vacant, and it was impossible to find anything. Everything that was getting built was getting pre-leased. Tell us where it was and where it is.
Yeah, so we are the poster child for the impacts of COVID, and really right now today, the excesses of COVID. Again, it's very dynamic, but it's also very stable. Our normal vacancy rate in the Inland Empire is about 4.5%. And usually over the past 10 years, we've had rent growth of about, anywhere between 8 and 10%. And that's kind of the healthy sweet spot of the market. COVID hit and it created really a dramatic change in our marketplace. First off, it created supply chain issues everywhere. So people were taking spaces unnaturally. They were making decisions based upon COVID behavior. They were making decisions like, and again, I'm sure you learned this in high school, but there's something called just in case inventory that corporate America has always been using as a metric. Nobody wants to store inventory unnecessarily. It's expensive and again, it's costly. And everybody's trying to be more efficient, not less efficient. And obviously COVID, the concept came up with the just in case inventory. And unless you're the federal government or the Pentagon, you're not doing that in any form or fashion long term. So during COVID, our vacancy rate went from that 4.5% down to 0.5%. And as you can imagine, if vacancy goes to zero, rents go to infinity. And so that's what happened. As vacancy went down, our rent spiked dramatically. And just in a 2-year period, we saw rents increase by 100%. So crazy occurrence, a natural occurrence, something that, I've never, as good as our market's been for a long time, I've never seen anything like it. And quite frankly, I don't think I'll ever see it again. And so that's kind of where we were, so let's just say the end of 22, heading into 23, everybody thought the market was continue to go forward. And what's happened is we basically are now dealing with the excess of COVID. So the impacts of COVID drove our market up 100%. And now we're dealing with a situation where vacancies have spiked. Corporate America woke up, figured out they had too much space. All the 3PLs figured out they had too much space. They'd taken space unnecessarily, again, with kind of wrong judgment or misguided, facts in making their decision. And again, it was hard to make decisions during COVID because obviously the times were uncertain and unprecedented. So what's happened in summary since the beginning of 23 is we've seen vacancy rates go from that 5.5% all the way to 6.8% just literally in about a 15 to 18 month period. Those vacancy rates are continuing to go up. I'll touch a little bit on the subtleties of that, but when vacancy rates go up that dramatically, we've seen prices change in return. From the peak pricing, we've seen lease rates decline about 40%, 35 to 40% off the peak values, and so. For many times during COVID, I talked to our corporate America users, and they'd say, Steve, how do we get out of Southern California? How do we avoid all this craziness in the rents? And I can tell you, I spent a lot of time with our supply chain guys during COVID, but I haven't talked to them in about 15 to 18 months because corporate America now feels like, number one, they're getting themselves right-sized. And number two, they feel like it's a fair fight now. So concessions are up, lease rates are down, and there's a lot of availability and a lot of choices for corporate American tenants. The other kind of thing that's of note is the dramatic increase in sublease space.
Yeah, sure.
When COVID was over and people woke up and the dust settled, everybody looked around and they had too much space. And so whether it was Lululemon or Skechers or the myriad of national and local 3PLs, everybody put sublease space on the market at the same time. And basically, again, in a normal market, we have about 2 to 2.5 million square feet of sublease space. Just 3 quarters ago, we peaked sublease space at 18.5 million square feet of sublease space. So
wow.
So lots of vacant space and a lot of decisions that were made again with not perfect facts.
Yeah, so that's really interesting. We're seeing obviously a lot more subleases here too, but on the leasing side, you've seen a correction. And I remember during the pandemic, on the investment side, people would talk about the Inland Empire. You hear about, a 3 cap, right? And obviously, with the impact of vacancy going up, that's impacted the investment side as well. So what has that done on the investment side? Obviously, cap rates have gone up, but where are cap rates and investment activity sitting today in that market?
Obviously, cap rates have gone up, interest rates have gone up, and negative leverage is never good for real estate. And so we've seen our cap rates go up, up to probably where they are today. If you talk to Mike Kendall, who runs our capital markets, he'd probably tell you in that 5 to 5.5 range. Obviously, much higher than they were, but still on a relative basis, quite low. The difficulty we're having is nobody's really selling because nobody can understand how to underwrite rents. And so The most difficult thing you can do right now is try to figure out where rents are going to go down to. I can tell you, given just the supply and demand dynamics, it's simple math, it's simple economics. When you have too much supply and not enough demand, rents are going to go down. So as rents are continuing to move down, I would say they're sliding in the West Inland Empire and they're dropping in the East until those rents kind of have some sort of level they level out a little bit. It's going to be very, very hard for people to underwrite lease rates and ultimately underwrite value of the sale assets.
Yeah, I would imagine it would be a challenge if you're, to your point, if you're buying on a 5.25 cap, but the lease is expiring in 3 years, and based on the then market, maybe you're suddenly crashing that to a what cap based on that change in rent value, right? Because it's going the reverse direction. Typically, it goes the other way, right? Most of our career.
Exactly. And again, it's just the math doesn't work.
Right.
And again, there are situations where people could sell their leased assets, but they aren't. I feel like there's not enough leverage where it's pushing people to sell leased assets because everybody feels like at some point interest rates are going to go down, cap rates are going to go down, and there'll be a better time to sell their asset. And so if it's stabilized, there's no pressure to sell. So nobody's really selling those. And what'll happen this year is there's going to be a lot of vacant buildings. And again, those are going to have to get either leased or washed out with a sale. And it'll be really interesting to see how those ultimately get priced. We've seen only one vacant deal get purchased, and it was done by Ares. But again, in a market that has 650 million square feet, to be pointing to one or two deals over the last 4 or 5 months, it's pretty crazy. It's basically pretty, for all intents and purposes, it's pretty frozen.
Yeah. Well, speaking of crazy, and shift gears a little bit, let's talk about the fires. I mean, you were grossly impacted. You live in the Pacific Palisades, and speaking for our listeners, really sorry for you and everybody down in California that's experienced just horrific wildfires. Tell us a little bit about your experience. I know you were in the paper, and your house was one of the few, I'm assuming, few that were saved. So tell us about your personal experience and where you're at.
Yeah, no, I am definitely in a much better place than most, or if not all, of my friends. The Palisades fire was very tragic. The Altadena fire was equally or even more tragic. I think 6,000 or 7,000 structures lost in the Palisades, and 9 or 10,000 in Altadena. I was lucky enough to have just a random occurrence. My neighborhood is probably 80 to 85% burned down. I went and visited 2 days ago, and it's basically like, almost like looking like what hell would look like, scorched earth for as far as you can see. Thousands and thousands of homes burned down, and obviously very tragic. But, for me personally, I'm in a very good spot. I don't have, a 5-year-old, an 8-year-old, an 11-year-old. I don't have my house burned down, my school burned down, my life changed and flipped overnight. I'm fortunate that I have older kids, and just myself, my wife, and the difficult things that we are dealing with today is just the survivor's remorse, and and talking to our friends on a daily basis that aren't nearly as good a shape. It's really a sad state of affairs, and quite frankly, tough to deal with a little bit every day. So, but every day gets a little better.
And where are you living, and how long do you think until you get back?
Well, I've been a bit of a vagabond. So I lived in a hotel for a couple of weeks, and then I lived in an Airbnb for a couple of weeks, and now I'm in my third Airbnb. So I'm bouncing around a little bit. It's a little bit of an adventure, and we're having some fun with it. But hopefully I'll get settled here in the next few weeks.
Very good.
Yeah, I'm glad that you're dealing with it the way you are, and sorry that you've had to go through that, and wish you the best certainly on that. Just on the business side, industrial real estate, has that been impacted from the fires and everything that's gone on with that?
Yeah, I guess it's a little bit hard to say at this point how it's all going to impact. And obviously you hear about kind of the vultures starting to circle, and people saying they're going to come back and rebuild, but in reality, rebuilding a custom home is not an easy thing. And then to try to rebuild a custom home while 5,000 other people are trying to do it is certainly a daunting task. And so we'll kind of see how that all plays out. As far as how this is going to impact Southern California and the industrial real estate market, in a very odd way, it can only have benefit for our market. People are going to have to, there's going to be a need for 5,000 refrigerators. There's going to be a need for 5,000 washing and dryers. There's going to be a huge draw on both human resources and also raw materials to build these new, to replace these, 10 or 15,000 structures. So from that standpoint, over the next few years, I certainly think it'll have a positive impact for our industrial market, obviously a negative impact on a lot of people.
Yeah,
for sure.
Unfortunately, that's the case. So what's your vision for 2025 for the Inland Empire, kind of as we, progress throughout the year? What do you think that looks like? Obviously, the market's already shifted some, but what does it look like for 25?
So what we're seeing in the Inland Empire, it's really broken down into two markets, so the Inland Empire West and the Inland Empire East. And it's basically a half and half. One's 350 million square feet, one's 300. And we've seen really a tale of two cities. The Inland Empire West has seen some pretty amazing demand. Just in 2024, we saw 58 deals get done over 200,000 square feet in the Inland Empire, and out of the 58, 44 were done in the West. So basically 75% of the demand is in the West. And that's all being driven by Chinese 3PLs. They're probably, 70, 80% of our demand driver right now.
Wow.
And so just in the fourth quarter, all 14 deals that got done over 200 were all done in the West. And again, 75% of them were done by Chinese 3PLs. And so they're a huge, huge driver. And for a long time, they were taking hundreds and 200s, and maybe a big deal was a 300, but now they're taking 500, 600, a million square feet. And so they're not all great financially. A lot of them don't have stellar balance sheets or a long history of paying rent. But quite frankly, I think that there's a lot of owners out there that are solving for occupancy, and they're, again, a big demand driver right now. I think that in 2025, we'll see continued basically healing of the West. And I think the West will stabilize. The vacancy rate has actually gone down the last three quarters in the West, while the vacancy continues to go up in the East. And so we'll see I think, things stabilize in the West as we head towards the middle and the end of the year. And then I think the East is really where some new price discovery is going to happen. I think, prices will continue to decrease there for the, foreseeable future.
Well, Steve, as always, you are incredible. Definitely one of our favorite brokers and a great friend. For the listeners, if you are in the Inland Empire, you're a landlord needing a building leased, if you are an investor needing a building purchased, sold, if you're a tenant needing space, Steve's your guy. We're going to put all his contact information here in the footnotes. Steve, I want to thank you for being on the show. As usual, you are phenomenal. Sorry again, what you're going through personally. Our thoughts and prayers are with you, buddy.
Awesome. Thanks for having me, and I'll see you in a few weeks.
Thanks a lot.
Thanks, pal.
Stand by for a second.